Hello and welcome to Premier Study in Investing. It's great to have you. Thanks for stopping by.
Hey, welcome back. So, I've been trying to sort out some of this catastrophic talk that we hear about in the finance world. Obviously, it's become clear to all of us that putting a bunch of fire and saying really vague things like it's over or watch out or total collapse is something that we constantly see in finance video thumbnails, and it may be a little bit toned down in mainstream journalism, but we find it there as well. So a lot of people are perhaps kind of wondering what's next, wondering about, like I have friends, they say, well, gosh, I was so nervous that we were going to have nuclear war. I'm like, really? I wasn't even thinking about that at all. They're like, oh yeah, like I was like totally knotted up about it. Other people are like, well, we're just waiting for, maybe World Economic Forum to do something crazy. I mean, we see Klaus Schwab all over the place now, right? And essentially what this is I think there's three stories here. We got to figure out which camp we're in. And these are big stories. These are stories that are not really covered by CFA, but these are sort of black swan type of total systemic banking failure type of things that we're hearing. I mean, what are the fat tails, and what happens if, say, 100 banks fail? And for me, it boils down to you have three guys that seem to basically, in my mind, be representative of where you have to land. So you could land with Rob Berger. Rob is a attorney, and his video on what happens to our investments if Schwab, Fidelity, or Vanguard collapses got about 1.5 million views. And he has hashtag broker, hashtag bankruptcy, and he's got almost 200,000 subscribers at this point. A lot of people really must have been wondering, yeah, what does happen if my brokerage goes bust? I'm a shareholder there. Like, what happens then? Rob kind of makes a 17-minute video. He also went on Wealthion, probably presented the same information, and essentially said everything is fine. So Rob is kind of the everything is fine, play TradFi, and that's probably the best way that you can do it. That if you understand the FDIC rules in America, that you're covered up to $250,000 on various accounts. And then he also goes over to what about the financial assets that are sitting, the ETFs, the bond funds, the CDs? What about all that? What about those assets, all those shares, my retirement account that I have, my Roth 401k? My brokerage? And he basically says, yeah, also no problem, because these are basically going to be backed up by a custodian. And in the case of Schwab, the example that he gave, the custodian was State Street. And so State Street is this massive bank that we're led to believe is too big to fail, backed by the government, highly, highly regulated, and that we kind of learned from 2008, and that's not going to happen again, the catastrophic banking failures. Yet that's constantly what we're hearing is hundreds of banks failing, massive losses. Now, believe it or not, the middle ground guy for me is David Hunter, which is a crazy kind of middle ground guy to have, because so Jeff Gundlach at Double Line did an interview at the beginning of, I think, 2023 down in Florida. And he thought that, that there would be a currency reset event. He thought that there's been one in the United States coming for a while, but he continued to bring it up. Jeff Gundlach, I mean, he's super famous. David Hunter, if David Hunter is famous, it's because he's been all over these podcasts on YouTube for the last 3 years talking about, like you see here, 40% melt up followed by 80% crash. And you can see this is all this year, and this is from a video that I found was posted 2 years ago on Wealthion. David Hunter has a crazy view as far as nasty volatility from the derivatives markets He also talks about global debt at unprecedented levels, and he's seen that the interest expenses are ultimately going to be unpayable. He has these wild calls: 40% melt up, 80% crash, meaning that, I mean, sometimes he'll put like the S&P 500 at like 1,500. Today it's at 5,200. So he has these really wild calls, but the reason that he does is for the reasons I just mentioned. And he thinks that something is going to break, rates are going to go to zero, money is going to get cheap, and we're going to have a huge COVID rally like we had back in 2020, where there's a bunch of cheap money. And if you know anything about DCF and valuating equity, when money is cheap, meaning when interest rates are very low, David sees them going to zero or negative, that it pushes valuations way, way, way up. So that's why he sees this 40% melt up. He thinks that there's going to be a huge rally, something like that, and then you're going to have an 80% crash because there's no economy behind it. It's just a bunch of cheap money. When stuff starts to break, in David's view, politicians will have no choice but to try to pass whatever they can, like they did in 2008, 9, and 10. $800 billion was the, I think, TARP, Troubled Asset Relief Program. So this was the Fed stepping in and buying a bunch of troubled assets in order to kind of save the economy, I guess you could say, stabilize things. Again, back then they dropped rates significantly. They also forced a lot of the bigger banks to step in and buy some of the assets, and some of them didn't really want to. PBS did a special on how Bank of America really didn't want to buy Merrill, and that Merrill has been kind of a problem still. Those bad assets have to go somewhere. Obviously, shareholders are going to take a huge hit. They're going to lose, 90% on their investments when Merrill went to zero. But still, it's a problem. And so David says that politicians are going to be forced to really play the only two plays that they have, is to cut interest rates, like I said, and then to print a ton of money. Because of the money printing the second go round, he thinks it's going to be massive, because you're paying for highly leveraged commercial real estate that's terribly overvalued. And so in David's view, if you're going to have a stock market that's maybe 6,000 or 7,000 on the S&P 500, but then inflation is going to get going, central banks are going to have to print a bunch of money, try to buy all this crappy, bad debt, and all the money printing and the spending by the governments is going to push inflation up to 12, 14, 20% is what he talks about sometimes. And that's like the total disaster for David. Now, despite how bleak that is, he believes the traditional finance system prevails and continues. So David is not trying to get out of the dollar. He's more of an asset allocator, where he's saying you want to buy things with pricing power. So commodities, farmland, soybean, wheat, oil, all the precious metals. That's David's play. And that's what he thinks happens. That's how you invest through it, essentially. But I mean that Vanguard continues, Schwab continues, Fidelity continues. Yeah, you have some smaller regional banks go bust, they're consolidated. And again, David thinks basically the system works, that things basically get worked out, that the zombie companies disappear. This is like the great cleansing that you need of financial institutions. You get rid of all the fats, and you start back over, I guess, with the S&P 500 at 1,500. And all the people that bought at the top at $6,000 or $7,000, they never get their money back in their lifetimes. I mean, even if it triples, it gets back to 4,500, and those people are still at a loss. They're still holding the bag. Now, his scenario is not as bad as this other guy. This guy, his name's David Rogers Webb. David Rogers Webb has the worst scenario I've ever heard. The interesting thing about him, though, is that he put his name on a book, gave the book out for free, and then goes on a bunch of podcasts. He describes himself as someone who's not seeking fame or notoriety. So it's not like he wrote this book as a type of person who wants to be right and wants to show everybody how smart he is. He's obviously not going to make any money off the book. And yet, on the right, Chris Mortensen picks him up. And Chris does like a 6-7 series podcast on something like The Great Taking. And that's the title of David Webb's book. And The Great Taking works like this. The Great Taking is that somewhere prior to 2012, there was a big push for what you see here, a harmonization in this chapter among financial institutions globally to agree to like a standard legal code of what happens when people buy assets, and then if the brokerages go bust or you have a large-scale insolvency. And the crux of his whole argument lies right here in this thing that we've probably never really heard of called securities entitlements. And securities entitlements works basically something like this. I open a 401k or a Roth or whatever. I transfer money in. I buy shares of, say, TLT, and I start building my retirement accounts. And everything is all good unless there's an event where there's a insolvency or a bankruptcy of, say, Charles Schwab or wherever I happen to have my shares. And David said in 2012 that the UCC, this is a Uniform Commercial Code, was rewritten or modified. And basically the gist of what he goes on to argue is that under the new rules, if you have a massive number of banks fail or a huge systemic financial crisis and lots of institutions go bust, and even the insurance companies guaranteeing deposits are not able to totally cover the losses, that whatever assets do remain go to some like privileged class, investor class, that has seniority in terms of the rights to the remaining claims, and that people like you and I who are shareholders have a junior position, meaning a subordinated claim to those assets. So to say it in more plain language, we get paid last. And unlike, or I should say like David Hunter, this gentleman, David Webb, believes that the indebtedness in the system, the interconnectedness of the global system, and the derivatives market, which they always talk about being $1 quadrillion. And no one knows how to value that, which I think is fair to say, because in one sense you could say, well, these are zero-sum financial products. Whatever is lost by person A is gained by person B, and so it all works out in that way, which is true. But not if the person who lost on that bet can't pay or won't pay. So it has to do with anything that's done on margin, or anyone who are buying or selling, anyone who's selling naked calls or naked puts. Without knowing the technical aspects about it, you know that hedge funds go bankrupt, obviously. So the reason this last position is so scary is because David Rogers sees that however it shakes out, once all the dust settles and all the leverage burns out of the system and all the people go bankrupt and all the normal people, they lose, say, like David Hunter's 80%, that the people that win on those trades, it all gets consolidated. And if it goes super bad and you start to have brokerages or financial institutions going bankrupt and large, massive banks fail, like Credit Suisse, then either those banks are bought up by other banks like UBS or Northwest Community Bank or JP Morgan Chase, or if we're talking about Merrill Lynch, was bought up by Bank of America. You have like a huge consolidation of wealth in the hands of whoever lives. But in the hands of most people, they lose everything. So your pension goes to zero. You're never repaid for your shares, whatever they're worth, because you have a subordinated claim, you have a junior claim on those assets. So you might want to check out this podcast on peak prosperity. From this point, I'm going to go through a bunch of different websites and try to paint a picture and make sense of which one of these guys is most probably right. Let's get started with Ray Dalio, Principled Perspectives. You can follow him on LinkedIn, no problem. Recently, he writes, in China, the 100-year storm on the horizon. Doesn't take a genius to know that that's a bearish story. That sounds like a bad story. A storm so big that comes every once in 100 years, and it's right over there. You can see it. That's what Ray is writing. It's March 27th, 2024. Now, it's interesting because the global financial crisis was really sparked in the residential sector of America. But it's not impossible for China to spark some kind of similar global crisis. Are we in a stock market bubble? February 29th, 2024, Ray Dalio. The meat of what he wants to say is right here in a couple graphs. The U.S. equity market bubble gauge. They came up with this, right? But some way to gauge where equity markets are. Anything looks like over 70% becomes in a bubble. So they look at 1929, 1928, and they look at like 1998 to 2000. And notice here we're only at 55%. Those other bubbles were, say, 85 or 95%, as you can see here and here. They're about 2.5 years long, both of them. And they're both really high on their gauge, above 80%, 85, or 90%. Where are we today? They say really no problem. Not particularly bubbly today, is what they write, as we're only at about 55%. So as far as Bridgewater, we're good. Like, let's just keep risk on, baby, unless we get sideswiped by some China event. Or unless we get sideswiped by commercial real estate. This is a bit old, 2022. It's from Bloomberg. MSCI is the source. What this is basically looking at the smaller banks pushed into commercial real estate lending. So who owns most of this commercial real estate debt? If this is 50%, orange is the biggest section for sure, which is regional and local banks. And we'd say it's a little bit more than halfway to the 50% mark. We'll say 27, 30% of this stuff is held by regional banks. The conclusion here, though, is what they're saying is for now, we're only seeing the sickest banks drop out of the herd. That could dramatically accelerate as that trillion plus in loans comes due. They're talking about somewhere close to $1 trillion of commercial real estate debt has to be refinanced in 2024. Or the other way you could say it is that it's maturing, and so a lot of that has to be refinanced. A new loan needs to be structured. And if it's reset in 2024, obviously the rates are pretty high. We haven't had rates this high in 30 years, maybe. This is an article, though, same article, Peter St. Onge, I think. He's also on YouTube. Commercial real estate threatens hundreds of banks. And he opens, pretty scary language. If you still got money in banks, Bloomberg is warning that defaults in commercial real estate loans could topple hundreds of banks. Now, why is this scary? If you go with the first thesis that, the system is well capitalized, it's backed by all kinds of different regulations, that if your local bank goes bust, the FDIC is there. You're basically insured, the normal person with, say, less than $250,000 in, say, CDs or money market accounts, or however the fine details worked out. If you just have a checking or a high interest rate checking account, like you're good up to $250,000. So why is that a problem? Why all the fear and stuff? Well, I guess he's saying that this is going to leave taxpayers on the hook, so that maybe you don't lose your account per se, but then taxes are increased, so you kind of end up paying for it kind of in a from the back door kind of way. You got to pay for it, or some of the programs that benefit you are kind of not funded as much because money has to go to this bank bailout program. He got all of his information from the senior editor, James Crombie, and we'll look at him, but he talks about, this guy walks us through a festering hellscape that is commercial real estate. So I've worked in commercial real estate for the last couple of years, and I'm telling you, it's not pretty. It is going to be very ugly. One of the things that, has made headlines recently is this talk about U.S. regional bank sell-off as a cautionary sign of more pain to come. And you see New York Community Bank, member FDIC. Isn't that nice? Well, these guys went bust. And the thing that you might not have noticed is that they bought up a decent amount of one of the banks that collapsed in 2023. So we'll look at that in a second. But one point to notice is that this article is going to try to make it a one-off thing, which I think is constantly what mainstream media is going to pitch us, is that, hey, this bank failed like SVB, but that's because they had a poor risk management person in place, one who didn't have enough experience, one who didn't understand the matching of timing of assets and liabilities. Anybody that knew what they were doing would have been able to, manage Silicon Valley Bank in a better way. And so that was just a one-off. Don't worry, everybody. That was a one-off, right? And we see the same thing here in highlight. While New York Community Bank's confluence of problems are unique to its balance sheet, elements of its earnings underscore regional lenders' ongoing sensitivity to high Fed rates, which continue to squeeze commercial real estate portfolios and lending margins. I can attest to you, I looked at a ton of different portfolios held by private equity firms, and the deals that were structured on fixed rate at, say, 3.5%, man, they were cash cows. They were just money machines. Those things had no problem. They were making their money. They were able to pay the interest expense on their loan. They were able to pay their principal on their loan. And they had tons of cash left over. But the ones that were on some kind of floating rate debt, and they were paying 8 to 12%, dude, those things were getting crushed. They're bleeding hundreds of thousands of dollars a month. So it's for real. A lot of people say, well, what's the easiest way to gauge this commercial real estate banking problem? They say, well, look at the regional banking index, .krx, and a lot of equities were down October 2023. This seemed to pretty much follow the market, and this is first day of February is when that New York Community Bank story broke. So it's trading at about $100. And within, say, 2 weeks, yeah, it's probably a 10% drop there. It's been fairly stable over the rest of February and March, but something to keep your eye on. So it's not like crazy, right? I mean, you have a basically upward trend here still. I don't know how much you can really pull out of that. So this is the James Crombie, senior editor, Post and Bloomberg. I don't have access to it, but he says, his title is interesting. Calling commercial real estate, quote unquote, manageable is just wishful thinking. He's going to give us a macro view. And just the headline is policymakers calling the roughly $1 trillion of commercial real estate debt coming due this year as manageable, quote unquote, manageable. They might regret it. If defaults topple hundreds of U.S. banks, as the pessimists predict, the impact on markets and the economy will be tumultuous. Well, no duh, right? The second part of the sentence is almost not even worth saying. The whole weight of the sentence relies on the first half. Hundreds of banks toppling. I mean, when was the last time that happened? I'll actually show you a chart of that. It did happen. 150 banks, 140 banks, 110 banks toppled in 2008, 2009, 2010. So we'll look at that. $1 trillion though, $1 trillion. He's taking this information just so you know. Mortgage Bankers Association, the MBA, they confirm you got $929 billion of the $4.7 trillion of outstanding commercial mortgages will mature in 2024. It's a 28% increase from what matured in 2023. And in 2023, it wasn't a pretty year, right? I mean, you had huge bank failures. Also look at that here in a second. But 2024 is going to be 28% larger than 2023 was. And we're also going to need to remember this number, 4.7 trillion is the total, what they say, of commercial debt. It's commercial mortgages, which is different than the value of all the assets of all the properties. It's just the mortgages. So 4.7 trillion in mortgages for commercial real estate in the United States. This is a graphical view. This is the 800 billion line. This is the $1 trillion line. 922 billion will come in right here. And so you can see how that breaks down. Depositories, credit companies, warehouses, commercial mortgage-backed securities, collateralized loan obligations, asset-backed securities, life insurance companies, Fannie, Freddie, FHA, Ginnie Mae. It's all part of this. So they all have different loans coming due. Depositories is the big part. And you can see it's much larger than what's coming due in these other years, also larger than 2023. Okay. So we're trying to deal with this number, 929 billion. Is that a big number? Should we be worried about that number? I mean, it's larger on this graph, but maybe it's no big deal. Well, here's the valuation. These are the bank failures in the last few years. So the largest was Washington Mutual Bank in 2008. It's $307 billion. But we had quite a year in 2023 with 1, 2, 3 different banks going down. By assets, the First Republic Bank was the largest, followed by Silicon Valley Bank, followed by Signature Bank. So I'm going to look here in a second. One of these 3 banks was bought up by New York Community Bank, which then failed, right? So they bought up these, you could say, toxic assets or these bad loans, and it sunk the ship. It put them out of business. You notice that these 3, if you add them all together, it's about $550 billion between these 3 banks in assets that, basically went bust. So again, the story is, this is no big deal because there's the FDIC, right? Like, this is all insured stuff. This is all planned for, provisioned for, insured. We don't need to worry. These are these are big numbers, but it's not like we had some societal collapse. This was May and March. This was spring 2023. It's not like unemployment went to 7% in the summer of 2023, right? No, I mean, the lights didn't turn off, right? Disneyland was still open. You probably still had your job. Like, no big deal. Well, here it is graphically, and it's pretty interesting because we're talking about the blue line, 550 billion in assets. This is bank failures in summary. This is put out by the FDIC. And so if you compare this blue line to any of the other blue lines in the prior years, it's way bigger than anything we've seen in the last 25 years, going back 25 years. This was the Washington Mutual in 2008. It was one big bank that went down, but this was three banks, and it's massive. If we switch over and we focus on the pink lines, pink is the number of institutions that failed. And so this was just three institutions, three pretty big institutions, right? But you could see there's been other years where James Crombie isn't crazy. There's 92 bank failures in the United States in 2011. There's 157 bank failures in 2010. And in 2009, there's 140 bank failures. 140 plus 150, call it 290, plus another 90 is 380. 380, let's tack on 25 more. Just call it 400 banks failed in 4 years, And I didn't even get to 2012. 450, 475. If you want to tack these on as well, all related to the great financial crisis, like 500 banks failed. But the total assets were not that big. The problem that these more doomsday guys bring up is that the leverage now is way crazier, like way crazier. So then I have to ask the question, okay, well, if we're going to go with this story from these people who say, well, listen, we have the FDIC, these are insured accounts, there's really nothing to worry about, just go back to sleep. Executive summary, second quarter 2023, deposit insurance fund balance sheet increased to $117 billion. It's like 117, like where's the rest? 117 billion. Bro, that's not going to be enough. It's fine if you're down here in 2019 or 2017, but it's not going to be enough if you have $550 billion of bank assets go bust. Like, it's not even enough by a quarter. It's not even close, right? So then I'm thinking, well, how then did that all play out? I mean, if the FDIC wasn't good for it, how come we don't hear about all these depositors like losing their minds and, blood in the streets and, people jumping off bridges and stuff, like they lost their entire life savings because the FDIC didn't bail them out. Like, clearly that didn't happen either. So what the heck happened? Well, Motley Fool put out this article. The FDIC assessed $16 billion to banks for last year's banking failures. It's really an article that is about how much banks are being forced to pay and like regulations, especially some of the bigger banks. But it does give us some helpful information about the failures. And I'm going to skip this one. I'm going to go down to this section, protecting uninsured deposits cost the FDIC over $16 billion. And they give us two important pieces of information. Related to Silicon Valley Bank, 85% of the money held at that bank was above and beyond the guarantee limit. So the FDIC guarantees up to $250,000. They call it a threshold. A lot of the venture capital and private equity funds that were holding money in those banks. I knew people in the commercial real estate sector that were banking with like Signature Bank. Yeah, there's a lot of banks. I think Weber Bank. There's a lot of banks that were on the high watch list back in spring 2023. So first thing to mention is that the insurance didn't work for 85% of the money, right? So if you're a big time investor, the insurance doesn't protect you very much. Let's say that. If you got $50 million you want to stick somewhere, you can't put it in the banks. Where are you going to put it? Maybe you're going to put it in the brokerages, or maybe you're going to buy gold, or maybe you're going to buy Bitcoin. I mean, I don't know. I'm not worth that kind of money, but I'm just saying. The other part of this that's really interesting is that the total cost of the failures of Silicon Valley Bank and Signature Bank, that's only 2 out of the 3, right? Cost around $18.7 billion for the FDIC. Okay, so that was like something like a seventh. It's like a sixth. Well, let's just round this up to 20 billion here is what it cost them. And we know that their balance sheet was 120 billion. Just call it 120 billion. It's 1/6. They lost 16% of their money dealing with this situation. Okay. Now, the other interesting thing you can do, you can say, well, there was a $20 billion charge that went to the FDIC on how much assets that were lost? 548. But hold on. We can't use those numbers because they're only talking about just 2 of the banks, Silicon Valley Bank and Signature Bank. So what's the value of those 2? Silicon Valley was 209, Signature was 110. Add those together, let's call it 330. All right. So it cost the FDIC $20 billion to clean up a $330 billion problem. So you do the math on that. You're going to take the, say, 20 divided by the 330, and you're going to get something like 5.75% is what the FDIC was on the hook for that type of cleanup. So assuming that they pay out about 5.7% of the total, then you could really just go back to their balance sheet. And you could take the 117 billion that they have, divide it by, say, 0.0575. And that means that they could, if they deployed all the money on their balance sheet, the whole $117 billion, they could clean up about a $2 trillion mess. $2 trillion of bank failures. Which is a pretty solid number, I guess you could say. Regional banks. Let's just do regional banks and national banks have about, say, 30% plus 15%, say 45% between those two. 45%. Well, before even getting that granular, if the FDIC can cover $2 trillion in losses, and we know that there's only less than $100 trillion coming up to be refinanced this year, seems like the FDIC could handle, say, like all this goes bust, and 45% of it is held by banks. It's like 450 billion. That'd just be like the same problem that we just had. So I think that first guy, this guy, Rob Berger, I'm going to say that I have to agree with him as far as small account holders like, you and I, people under $250,000 limit. There should be FDIC money there to deal with any commercial real estate repricing. Because we just had a huge year. We just had a massively nasty year in terms of total assets held by failed banks. The question is, how did they only have to pay 5.7? I think what that must mean is that 5.7%, because at least we know in the situation of Silicon Valley Bank, 85% of the funds held in Silicon Valley Bank were uninsured. So let's say that was true for the other banks as well. I don't know if it was or it wasn't, but I think there was a lot of people, at least in the companies that I knew in commercial real estate, that were scrambling big time. I mean, the treasury people worked all weekend trying to get their money out of Signature Bank by Monday morning. And they didn't get all of it out, but they were trying to do everything they could to get every last dollar out. So let's say 85% of the $550 billion was uninsured money. Let's do it a different way. Let's say 15% of the 550 was insured. It's 82 billion that was insured, perhaps. The question is where those losses go. Because maybe Bank of America or JP Morgan Chase, somebody buys these banks up for pennies on the dollar. So definitely the shareholders lost 95% of the value that they put into the company, equity investors. Bondholders, let's say corporate bondholders, also lost 95% of their investment. So this hits who? This hits like pension funds and international investors and 401k folks, hedge funds, and then obviously everyone that had a job with Merrill or any of these companies. Obviously, people are talking about the lost investment for tech and innovation in Silicon Valley, which is kind of the bread and butter of the United States. If all those hedge funds were not able to recover their money, I mean, I guess that's basically like wealthy people that put their money in hedge funds because of the lockup periods and everything. And you have certain limitations before even getting into something like that. You have to be a high net worth investor. So it seems like in general, like if we were able to manage these historically high bank losses in 2023 and all hell didn't break loose, then we could probably do it again and be okay. These are big assets, but in light of the commercial real estate environment, it's not like there's that much money really coming back to be refinanced in 2024. There's some, but it's not like a tsunami of money. This commercial real estate, I mean, this is not going to fall under the $225,000 limit insured by the FDIC. These are going to be losses incurred by real estate investors, private equity funds, and I mean a lot of pension funds, state pension funds, or teachers funds, retirement funds have gone looking for better returns with commercial real estate. So that does come back to the average working person. But it's just really hard for me to see that commercial real estate, even if half the stuff goes bad, is just going to wipe out the entire system. Even if you have some commercial banks, regional banks go bust, they're probably just going to get bought up by these bigger banks. I guess in that sense, I'm sort of more moving now towards like David Hunter's thesis, where it would be crazy. I mean, it would be super crazy. A third world war, like 3 hot wars going on at the same time, or a highly leveraged system, or some kind of like massive thing with Country Gardens just went bankrupt in China, a real estate developer. Evergrande went bust, and there's this third firm. Their revenue was down 45%, and they're a big real estate developer, as well as most Chinese people have most of their assets in real estate. Still, looking at this, it's hard to imagine that hundreds of bank failures. I mean, it could happen, And you can see the volatility like David Hunter is talking about. Some kind of 40%, 80%, huge swings in interest rates, followed by all these nutty corrections, and maybe a time of super high inflation, 1970s type inflation. But to get all the way over to this guy, you need to believe in something a little bit more nefarious going on here, which for some people, nefarious is completely within the realm of possibility after some of the institutional shenanigans and the lost in institutions, what many feel like is a betrayal of the healthcare system throughout the Western world in terms of research and transparency and honesty, and especially as it's gotten politicized, people will say whatever, whatever they want, it seems like. But you have to get in that type of mindset to go with this guy, or you have to be able to read the UCC. So, like I said with him, he thinks that the Uniform Commercial Code was really rewritten, reestablished, with some new rules in 2012. And this is from Cornell's law school. And so you can read it, but it's probably not very easy to read. He focuses mostly on security entitlements here. Doesn't look that easy. I guess before you get into David Webb's perspective, just listen to his books for free. Somewhere you can get the book in MP3 format, but what you really need is a PDF version of it. There it is, The Great Taking. You can get all the references. So here with the references, you can figure out which parts of the Uniform Commercial Code he's talking about. I'm sure that'd be like a huge rabbit trail, and one that most people would probably just look at you like you're crazy if you start talking to anybody about some sort of setup, some kind of free PDF book that you found on the internet from some podcast. Well, you guys, beyond reading the book, that's probably as far as I can take this. Certainly, though, after this video, I don't think that I can stick with this guy. And one of the reasons why is after looking at the situation with Credit Suisse going down and being bought up by UBS, there's clearly like a demarcation that the depositor protection works on a 3-tiered system, and that there is like a seniority of claims. And that this particular insurer is limited by law in Switzerland to 1.6% of total deposits in Switzerland. So either that means payment liability. They're not allowed to, they wouldn't have to pay out more than 1.6%, which would obviously be a huge sum. But rather than reading the Uniform Commercial Code, I would start by working through David's book or listening to this podcast on peak prosperity. I should note that Peak Prosperity is not the only person that's had David come on and talk about his views. So, and then the other thing to notice is that constantly these websites are selling, right? What are they always selling? It's just like all those Republican podcasts. They're always selling commercials for gold and silver, right? It's always like textbook, like get this, get some guy on that has this awful future view and then sell a whole bunch of gold and silver coin, bullion advertisements. You gotta disentangle the business of what this is and how these people make money, and really question like what are their motives. Because also Chris Martenson is not a dumb guy. He's trying to build a reputation. The more eccentric guests that you have on and the further that you run and entertain their ideas, the more it kind of paints a picture of who you are, your reputation, but see, he's doing multiple parts. Part 4, 3, more of 3. I guess it's only 4 parts. 4 parts, huh? So they probably have more content behind their paywall. But, yeah. I just think that's something that is probably worth reading, although it's going to be super depressing. And I already know that David's take at the end of everything is like, the wrong question is, where do I park my money to avoid all of this? Because even one of the things is like nowhere to hide, I think. Safe harbor from whom and from what? He says that the people that he talks to, the institutional people that believe him, they're always like, what should we do with our money so that we don't lose it? And he's like, wrong question, The more humane question is, how do you restructure the Uniform Commercial Code to protect all of your, fellow humanity? How do you protect the broader society? That's the right question. The wrong question is, where do I, where's the 1-800, Gold R Us dealer or whatever. So I think one of the problems emotionally with entertaining a guy like David Webb is that it's easy to assume that it's not a black swan event, but that there's no way that the system could have been that corrupted. But then if you do come to believe that it has been that corrupted, then you have to try to start moving all of your assets into, I don't know what, maybe housing or farmland or something that you own completely debt-free, move completely out of financial assets and move into real assets. So businesses, gold, real estate, and that's all I have for now. Thanks for watching. I'm going to keep thinking about it. I don't have anything else to say. Bye.